In this video, we'll demonstrate some additional problems at the end of Chapter 13. If we look at problem number 41, where Evelyn has rental income of $48,000, passive income of $18,000. She has $148,000 of losses from her rental real estate business in which she actively participates. And since the word activity is used to test whether or not these passive losses may be used against non-passive income, up to $25,000. And then Evelyn's AGI is $95,000. So I just entered the data for problem 41 on page 1342. The first thing, intermediary calculation, what were the net amount of the losses? In this case, I took the losses from the real estate activity and I deducted the income from passive income and the rental income as well. So I wound up with the net passive losses just by combining them. The amount of passive losses that can be netted against other passive income, again, this is just adding together the $48,000 and the $18,000. And then finally, the amount that she might be eligible for to deduct these passive losses against other income. And that she qualifies for the $25,000 amount. So the question is, how much of the loss can be deducted without regard to at-risk rules? And it turns out then we would just sum the total of the amount of passive losses that can be netted against other passive income, which we said was $66,000. That's just the 48 plus the 18. And then we'll add to that the $25,000 of active participation from the real estate losses that can be netted against active or portfolio income. And so she winds up with $91,000 total. Next one we'll look at is number 44. Just wanted to mention for number 44, this is a case where we have to allocate losses between activities. And so for number 44, Robert had the following income and losses from passive activities, and it lists activity 1 had a loss of $20,000. Activity 2 had a loss of $10,000, and activity 3 had a loss of $5,000, and activity 4 had a gain of $33,000. And so when we look at the netting of these together, we have to kind of consider that if there's been a suspended gain or loss, for number 44, we have a situation where we have to allocate losses that are suspended among activities. So number 44 on page 1342, activity 1 has a $20,000 loss, activity 2 10, activity 3 $5,000, and activity 4 actually had an income of $33,000. Amount of activity 4 passive losses that carried over from a prior year was given at $10,000. And then it gives us the taxpayer's wages of $110,000. So Part A asks, how much of income or loss does Robert have from the 4 activities? So in Part A, I'm just going to add together the $20,000, $10,000, and $5,000 losses, to the $33,000 of gain. So if you add these together, you have a net loss of $2,000. And so that's the amount of loss that's suspended. That can't be used in the current year. Okay, so the next calculation is how are the suspended losses allocated? And this is what I wanted to demonstrate. So this is just an apportionment or an allocation of the losses, the $2,000 total, allocated between the activities, because we know we had a total $2,000 loss after netting all of the income and losses from activities 1 through 4. So I needed to calculate a percentage, and I did that by taking, for example, for activity 1, I took the loss from activity 1 of 20,000, and then I just divided that by the total amount of the losses. So it'd be 20,000 plus 10 plus 5,000 in the denominator. And it came up with 57.14%. I just applied that 57.14% against a $2,000 loss. And I came up with 1143. And I just repeated that same calculation for the other two losses from activity 2 and 3. Part C asks, well, if activity 1 were sold at an $18,000 gain, what would be the total income or loss from the 4 activities? So when we look at activity 1, it has been sold, and the amount then of the total income or loss that we need to consider is we're going to take first the $18,000 sale price, and to that we're going to add the amount of suspended losses from activity 1, which was 1143, and then we'll also add the amount of suspended losses allocated to activity 2, as well as the amount of activity loss that was allocated to activity 3. When you add all those 3 together, you wind up with the $16,000, which is this $18,000 minus the entire $2,000. So that's the total income that we would recognize from the sale. Now, when we look down from the total income from activities 2, 3, and 4, in this case, there would be 0 total income or loss. And rightfully so, it says since the gain on the sale of activity 1 exceeds the suspended loss of $2,000, the net amount of $16,000 is taxable income. So the entire $16,000 then, after netting out 2 against the 18, is taxable income. So the major point here of this particular demonstration was to isolate and describe the allocation of losses between the activities. Okay, let's go down then to number 47. Jackson invested $190,000 in passive activity. His at-risk amount is given at $45,000. His share of income and losses in the activity is $52,000 loss in 2016, $20,000 in 2017, and an $80,000 gain in 2018. So we have losses in 2016 and 2017 of $52,000 and $20,000 respectively, and then an $80,000 gain. And so I just reproduce those values given in the problem. Now, we have to do some important intermediary calculations, because you'll recall that we have 2 tests to look at to determine whether or not the passive losses can be deducted against that year, and therefore deducted against passive gains. We have to consider the at-risk disqualified amount, so we have to look at any disqualified balance, and that balance we have to keep track of first for the at-risk balance of the disqualified losses. Then the amount that gets through to the passive activity loss test, the PAL test, we also now have to track that balance of the suspended passive activity losses. So we have these 2 balances that we need to consider, but we also have to remember that the at-risk rules must be determined first, because they need to make it through the at-risk rules in order to get to the passive activity loss consideration or test. All right, so let's demonstrate what this looks like. We're told that we have a $45,000 at-risk at the beginning of 2016. So right now I'm just looking at the first test, the at-risk test. Okay, we're given the $45,000. The amount at risk at the end of 2016, however, is 0. And why do we go from $45,000 to 0? Because the $52,000 loss essentially consumed all of our at-risk amount. And we had $7,000 or disallowed at-risk that's left over, right? $52,000 minus $45,000 is $7,000. So here's that disqualified at-risk amount that we need to keep track of. But at least as of the end of 2016, we have nothing at risk. There's 0 at risk now. since the loss in 2016 consumed our entire at-risk amount. And we have the $7,000 disqualified at-risk amount that we can't use this year. All right, now we're going to look at the passive activity loss, still in 2016, but we're going to look at the passive activity loss rules. Well, $45,000 made it through. Remember, we have $52,000 loss in 2016. $45,000 of that made it through the at-risk rules because it was entirely used up that year. Therefore, that $45,000 can be considered in the next test, which is the passive activity loss rules. However, the $45,000 passive activity loss rules is suspended. And the reason it's suspended is because there's no passive gains to offset against it. So now we have our second balance that we're tracking. We're tracking the passive activity suspended but loss balance. And that's, in this case, $45,000. So we have $7,000 of disqualified at risk, test 1. And then since $45,000 did qualify for at-risk rules and got past the at-risk rules to get to the passive activity loss rules, unfortunately, yes, it got to the passive activity loss rules, but there's no passive gains, as I mentioned. So the entire $45,000 will be suspended for passive activity loss rules. So just remember, we have to keep these two balances in mind. On to 2017. At-risk amount for 2017 is 0 because the ending balance at-risk amount in 2016 was 0. Therefore, we start with no amount at risk. So again, we're looking at the at-risk rules first. The total amount then that's disallowed as of the end of 2017 of these at-risk losses is the $7,000 we started with, plus we lost an additional $20,000 in 2017. So the $20,000 plus the $7,000 together, 20 plus the 7, is $27,000 of disallowed at-risk rules. So our at-risk amount is still 0 at the end of the year. That hasn't changed. But now we've increased our disallowed at-risk amount because, like I said, we started at 7. We had $20,000 loss in 2017. That increased it to $27,000. Staying in 2017, we go on to the second test, passive activity loss test. Well, the passive activity loss test means that we're going to have that same $45,000 suspended because there was nothing at risk in 2017. Therefore, nothing made it through to the second test for the passive activity losses. Since nothing made it past the at-risk test in 2017, the previous passive activity loss rules just carry over and are not changed. Okay, so there we have the $45,000 passive activity suspended balance at the end of 2017. So now, dealing with some of the questions that we have to address in this problem, what is the amount deductible in 2016? There's nothing deductible in 2016 because, as we said, although $45,000 in 2016 made it through the at-risk test, unfortunately, there was no passive income to offset against the losses. So the entire $45,000 was suspended. Therefore, 0 losses are deductible. And the same is true in 2017. All right, so we have 0 for the answers to 2016 and 2017. Next issue, now we're moving on to 2018. Remember, in 2018, they made some money, $80,000 in this passive activity. That means that increases the at-risk amount, and now we might be able to take some of these suspended passive losses and deduct it against some of the income. Okay, so the part for 2018 changes things a little bit. So let's look at row 90. Amount at risk and amount of passive activity losses to apply against income at the end of 2018. So in this case, we're going to go back and we're going to add all of the at-risk amount in 2017, and this is the disallowed amount of $27,000. So now we're going to take that $27,000 for at-risk purposes and we're going to add to it the suspended balance in 2016 for passive activity losses. So the $27,000 plus the $47,000 will give a total of the $72,000. Again, that's $27,000 disallowed at risk plus the $45,000 suspended balance. Gives us $72,000. So that is the amount then that we can apply against the income. Well, we had $80,000 of income less $72,000 that we can use now, which is the previously disqualified at-risk amount plus the suspended passive activity losses that we couldn't take advantage of. And we wind up then with a total taxable income of $8,000. $80,000 of the income less the $72,000 combined at-risk rules plus passive activity loss. And we wind up with the $8,000. All right, so that's kind of the progression that we walked through for multiple years, where we had both disallowed at-risk and suspended passive losses. And I'm just going to show this in case you want to stop the video, where I walk through some of these calculations for you. So I'll just show this, so in the event you want to stop and run through some of these calculations yourself, feel free to do that. And then the last thing I wanted to mention was the AMT, the alternative minimum tax. A couple of things. In problem number 52, here we have Carson had the following itemized deductions, and they just sort of just listed here, the itemized deductions. I just reproduced them here. One thing to remember is that as a result of the Tax Cut and Jobs Act of 2017, it's really simplified things when you compare the regular tax system to the alternative tax system. And so all of these itemized deductions stay except for the state income taxes. Those are not allowed for AMT purposes. So I just took added the total expenses together. And then the question is A, Carson's itemized deductions for AMT, they're all of these except take out the $1,500, because they do not qualify for AMT purposes. So that's the answer to part A, is the AMT itemized deductions, all of them except the taxes. And then the amount of AMT adjustment would be the $1,500 that we're excluding for AMT purposes of itemized deductions. So that's all that was to problem 52. And then down to 53 is at the top of page 1345. So we have taxable income 2018 of $87,000, regular tax. This is using the regular tax system of $15,176. AMT adjustments were given to us of $125,000. Standard deduction for the single taxpayer in 2018 is $12,000. So the alternative minimum taxable income. Again, if you want to reference the formula that's listed in the text, they do a nice job of presenting a step-by-step formula that we would go through to determine alternative minimum tax, the alternative minimum taxable base, as well as the alternative minimum tax itself. And that AMT formula is found in the middle of page 13-23. So in this case, I'm going to start applying that formula. And so I'm taking the amount of the taxable income, which is our starting point, and then I'll add to that the amount of the AMT adjustments. So now we're converting from regular taxable income to the alternative minimum taxable income. 87 is regular taxable income plus the $125,000 AMT adjustments, and then we're going to add to that the standard deduction of $12,000. So now we have the AMTI of $224,000. Exemption amount, this amount is given to us in the table on page 1530. And this taxpayer qualifies for $70,300. That's just given in the table. There's no calculation there. Now I need to determine the alternative minimum tax base. That's the next after deducting the exemption from the AMTI. That is $224,000 AMTI minus the full exemption amount of $70,300 gives the alternative minimum tax base of $153,700. Now this $153,000 we have to apply against one of two tax rates, either 26% or 28%. And I'm just going to show this comment here to make it a little bit more straightforward. And we determine this by looking at the amount, and in this case the amount of the taxable base. Now the text says look at the amount of your AMTI. That's not correct. You want to look at your tax base, because the AMTI is up here at 224, but you have to deduct the exemption amount. So you want to look at the AMTI base, the AMT base, which is $153,700. And it turns out that the rate we would apply between 26 and 28% would be the 26%. All right, so you apply that 26% times $153,700, the alternative minimum tax base, and then you wind up with $39,962. So what does that say? That is your tentative minimum tax. Well, now we're going to look at the amount that we already determined for regular tax purposes, which we said was $15,176, and the tentative minimum tax is up at $39,962 using the AMT rules. Net the $39,962 with $15,176, and you wind up with an additional, or an AMT tax of $24,786. So what we're saying essentially here is we're saying that under the regular tax rules, this taxpayer only owed $15,176. However, under the AMT rules, they owe $39,962. So the difference between the two is the additional tax, the AMT tax for 2018 of $24,786. If you have any questions on these or any of the problems or concepts that we discussed in Chapter 13, please let me know.